In Part A, we examined the accounting structure, mortgage mechanics, financial statement propagation, and how ownership restructures the household operating system. But now we arrive at the deeper question. Because once the ownership structure enters the system, how does the system behave under pressure? This is where fragility, leverage, liquidity, survivability, and optionality all become critically important. Because a house purchase does not simply create wealth potential, it also creates structural sensitivity. And the real danger is that fragility often develops quietly. The household may look successful externally, while internally becoming increasingly rigid. This is where the real systems analysis begins. One of the most important consequences of home ownership is the expansion of fixed obligations. Under renting, many costs remain flexible, adjustable, or quite frankly, avoidable. But ownership fundamentally changes the structure. Now the household carries mortgage payments, property taxes, insurance, utilities, maintenance, repairs, and capital expenditure obligations. This is critically important because fixed obligations behave very differently from discretionary spending. Discretionary spending can be reduced quickly. Fixed obligations usually cannot. And as fixed obligations rise, the household becomes increasingly structurally rigid. This is exactly the same concept studied in managerial accounting, operating leverage, and corporate finance, because high fixed cost structures increase break-even pressure, shock sensitivity, and survivability risk. Let's look at the contribution margin framework. And if you haven't seen the videos on contribution margin, I would highly recommend looking at those earlier in this channel. This becomes extremely important. As fixed housing costs rise, contribution flexibility falls, meaning less income remains available for investing, savings, optionality, and future adaptability. The system gradually shifts from adaptive to dependent. That transition is subtle but enormously important. Now we introduce, again, a critically important concept, degree of lifestyle leverage. This becomes one of the defining frameworks of the entire series. We can define it as the sensitivity of household flexibility to recurring fixed lifestyle obligations. This is extraordinarily important because two households with identical incomes can possess completely different survivability characteristics. One household may maintain low recurring obligations, strong liquidity, and wide optionality corridors, while another commits heavily to fixed lifestyle infrastructure. And that, once again, changes everything. Suppose, for example, household A has fixed obligations which equal 35% of income. Household B, on the other hand, has fixed obligations that equate to 70% of income. Now introduce job loss, inflation, or interest rate pressure. The outcomes diverge dramatically. Why? Because high lifestyle leverage creates structural dependence on continued economic stability. This is one of the most important concepts in financial survivability. Here's the key insight. The issue is not whether the household can make the payment today. The issue is how much future uncertainty the system can survive tomorrow. That distinction changes everything. Now we examine degree of financial leverage. This is where mortgages become extremely powerful, because leverage amplifies both upside and downside. A 5% increase in housing prices can significantly increase household equity, but a decline in housing prices can also destroy equity rapidly. This is classic leverage amplification. Suppose, for example, that you have a $700,000 house, $140,000 equity, and a $560,000 mortgage. Now, a 10% decline in home value reduces the house value by $70,000. But notice, that $70,000 decline comes directly from the household's equity position. meaning the household lost 50% of its original equity. That is leverage amplification. And this becomes extremely dangerous when paired with weak liquidity, high fixed obligations, or unstable income. Here's the key insight. Leverage is not inherently good or bad. Leverage is simply an amplifier. It magnifies outcomes, volatility, fragility, and survivability pressure. This may be the most important insight of the entire episode, because many households become asset rich but liquidity poor. Externally, the household appears wealthier, established, and financially strong. But internally, cash flexibility may have deteriorated significantly. This distinction is critically important because net worth cannot always absorb shocks quickly. Liquidity can. Liquidity is survivability, adaptability, and shock absorption capacity. And homeownership often converts liquid flexibility into illiquid, long-duration infrastructure. That trade-off matters enormously. Here's the key systems insight. High net worth does not automatically mean high resilience. A household with strong liquidity, low leverage, and low fixed obligations may actually possess greater survivability than a household with a large home, high debt, and weak liquidity reserves. That is a profoundly important systems insight. Now let's stress test the system. Suppose the household encounters job loss, interest rate increases, inflation, housing price declines, or major repairs. This is where the true architecture becomes visible. Strong systems typically possess liquidity reserves, manageable leverage, lower fixed obligations, and operational or lifestyle flexibility, meaning that the household can absorb shocks, adapt, and survive uncertainty. In contrast, fragile systems often possess thin liquidity, high leverage, elevated fixed costs, and narrow optionality corridors, meaning small disruptions create disproportionate stress. This is exactly how financial fragility develops, quietly, gradually, then suddenly. The goal of household finance is not simply maximizing visible lifestyle consumption. The goal is constructing a system capable of surviving uncertainty. That distinction changes how every financial decision is evaluated. And now we arrive at the deepest layer of the framework, optionality. Optionality is future flexibility, future maneuverability, and preserved strategic choice. Strong systems preserve optionality. Fragile systems compress it. And home ownership often creates both wealth-building potential and optionality compression. This is the key trade-off. Ownership may increase long-term wealth while simultaneously reducing mobility, career flexibility, relocation capacity, entrepreneurial freedom, and adaptability. Again, this is not good or bad. These are simply structurally different systems. So here are some final systems insight. The strongest financial systems are not necessarily the most luxurious, the largest, or the most externally impressive. The strongest systems are often resilient, adaptive, liquid, flexible, and capable of surviving uncertainty. Because ultimately, wealth is not consumption. Wealth is preserved future freedom.